Hey guys, welcome back to another video. Today we're going to be talking about the accretion dilution analysis and providing a quick overview on the analysis itself and then going into 3 practice questions. Now this is something that you need to know for investment banking interviews, whether it's a summer analyst role or a full-time analyst role, and it's something very important, especially when you're going into the M&A group and you're analyzing different transactions and their net result on the acquiring firm. Now, the accretion dilution analysis measures the effects of a transaction on a potential acquirer's earnings, assuming a given financing structure. That financing structure can range between, financing the deal by raising a debt and purchasing it all with cash, or using your stock as a form of consideration by issuing new stock and new shares in your company and then giving those shares to the shareholders of the target company. It centers on comparing the acquirer's earnings per share pro forma for the transaction versus on a standalone basis. So you're comparing what your EPS is today versus what it would be if that transaction were to be completed. If the pro forma combined EPS is lower than the acquired standalone EPS, the transaction is said to be dilutive. Conversely, if the pro forma's EPS is higher, the transaction is said to be accretive. Now, acquirers target accretive transactions as they create value for their shareholders due to the fact that the market usually responds favorably. Now, I just want to say something about that. The problem with that statement is that historically, yes, the view is with growing EPS, it's considered healthy for the company and therefore good for shareholders. However, the same can be said for companies that buy back stock. And by reducing the number of outstanding shares, you don't even have to increase net income because earnings per share will increase because of the denominator in that equation, which will decrease, and therefore EPS will increase. So really, when you talk about creating value, you're looking at the net income side of the equation. So majority of the time when you're using stock, all the time when you're using stock to complete a transaction, the number of outstanding shares will increase based on the standalone versus the new company once that transaction is completed. But what you're focusing on is that growth in outstanding shares. Does it exceed the growth in net income? If it does, then that means that it's dilutive. But if it doesn't increase as much, then the transaction is accretive, right? So that statement, you got to really think about it from the transactions perspective, focusing on net income, not just the outstanding shares. Now, the key drivers for the accretion dilution analysis are the purchase price, the acquirer and target projected earnings, any synergies really realized in the deal, and the form of financing, most notably the debt to equity mix and cost of debt. Now, a quick rule of thumb is for 100% stock transactions, if the acquirer has a higher price to earnings ratio relative to the target company, then the transaction is considered accretive all the time, because price to earnings really it represents the price for $1 of earnings, right? And so if you are the acquiring firm, your earnings are priced at a higher level relative to the target firm, which those earnings are priced at a lower level, then you are buying earnings at a cheaper rate, and therefore that's beneficial for you. So in 100% stock transactions, when it's all financed by stock, if the acquirer firm buys a target firm that has a lower price to earnings ratio, the acquisition is always considered accretive. Now, just a quick review of the EPS formula. So EPS is essentially net income divided by total outstanding shares. And just going back to what I talked about, in the case of a stock buyback program, you don't have to increase net income. In this scenario, if net income is 2 if net income is 10 and total outstanding shares is 5, the EPS would be 2. But if you were to keep net income at 10, but were to reduce total outstanding shares by 4, so from 5 to 1, all of a sudden your EPS increases to 10, right? Even though your net income, really the performance of your business has not changed, it's just the denominator that has changed. So that's the grain of salt that you should take when you really make this statement that acquirers target accretive transactions as they create value for their shareholders. But I won't go on too much about that. I already made a separate video on that, so I do recommend that you check that out on my channel. Now, the accretion dilution analysis can be completed in 3 steps. Number 1, calculate the combined company new outstanding share count. Then you calculate the pro forma net income of the combined entity when the transaction is completed. And then you divide that pro forma net income by the new outstanding share count. Now, this is very important. Start by finding that new outstanding share count. Don't go with net income just yet. the easier way is to start by valuing that deal and working your way to understand what amount of new shares are issued in the transaction, and then you can calculate the pro forma net income and complete that the analysis, right? And majority of the time in interviews, they're going to be really whole numbers, so it's going to be relatively easy mental math, but it's important to approach the question in that manner. Now, a more exhaustive calculation, really, this is the fuller calculation which you would do in Excel if you were to actually complete a full accretion dilution analysis. You start with the acquirer's projected EBIT, you add the target's projected EBIT, you add any expected synergies which will result in the new standalone company increasing its EBIT. You subtract the transaction-related depreciation and amortization, so any new D&A. You then subtract the acquirer's interest expense and subtract any new incremental interest expense that has resulted from the transaction. You then subtract the tax expense at the acquirer's marginal tax rate, and that would be the new pro forma net income from that result, right? And then you can account for any changes in fully diluted shares and divide that new pro forma income by the new fully diluted shares outstanding. So really, just to exhaust the point, when essentially the accretion dilution analysis, you want to make sure that you are accounting for any changes in this exhaustive calculation. You want to account for any changes to pro forma net income. We start at EBIT because really the new sources of expense or the new sources of revenues originate from expected synergies plus the target's EBITDA. So you can just EBIT, and you can add those two to the acquirer's projected EBIT, and then you can account for any new expenses that arise. So you have the existing acquirer's interest expense, but then you also add the new incremental interest expense. Now the existing acquirer's depreciation amortization is already accounted for because we're starting at EBIT, not EBITDA. Right? So the only thing that could really impact this transaction is any new transaction-related depreciation and amortization. And then you can just take away tax, and then you get your net income, right? So that's how really you calculate pro forma, the more exhaustive way of doing it. Here's an illustration of that. You have the acquirer EBIT, you then add target EBIT, and then you add any synergies, and then you start to subtract things. So you have your depreciation write-up, and you have the amortization write-up, so the new incremental depreciation amortization that originate from the transaction. You then have the standalone acquirer interest expense, which needs to be accounted for because we're starting at EBIT, right? So you take away EBIT. You take away interest from EBIT to work your way down towards net income. You then also account for any new incremental interest expense from that transaction. You then take away taxes because now you have earnings before tax, right? So EBT. And then you get your pro forma net income. And then you can also account for any new shares issued in the transaction to get your pro forma EPS relative to the standalone EPS. And that's essentially the accretion dilution analysis in more of an illustrative way. So just to quickly review, excuse me. So in a stock-for-stock transaction, the number of acquirer shares exchanged for target shares is calculated using the exchange ratio. So this is the formula that you use when you're evaluating a deal, which uses stock as acquisition currency. So you have to determine the offer price per share that will be financed by the by stock, right? So the acquired share price is whatever the share price is trading at once the deal before the day before the deal is announced, and the offer price per share, if it's a 100% stock transaction, is the full offer price. But say, for example, it's financed 50% through stock. Well, then it's 50% of the total offer price because 50% will be financed through cash and the remaining 50% will be financed through stock. So you put that 50% that is financed through stock. So really this offer price is the offer price, the component of the offer price that is financed through the stock currency, right? So consider an example where the acquired share price is $100. That would be the denominator. And then the offer price per share is $50. If the deal is funded 50% with stock, so $25 through stock, you would input the $25 in the numerator and $100 in the denominator to get an exchange ratio of 0.25 shares. Now that result, that exchange ratio, is essentially the number of shares the target shareholders get from the acquirer. So if I held one share in the target firm, I would receive 0.25 shares in the new firm. That's essentially what the formula is telling you. Now, another thing, the financing mix kind of theory behind it. So when the mixture of debt and equity changes, how does the accretion dilution analysis respond? I think this is really important to understand if we were to really play around with the form of financing, how that impacts the pro forma EPS. So really the focus and the core change is on new fully diluted shares outstanding. So the merged entity will combine its projected net income with the projected net income of the target firm, right? But the big change originates from really that the number of new shares that are issued. So look at Company A and Company B. Company A has projected net income of $10 and Company B has projected net income of $5. Now, assuming no synergies, we combine the two. So in the new combined entity, the projected net income is $15. Now, each company on a standalone basis has fully diluted shares of 1 and 1, right? So each of them have 1 share, right? Now, when a deal is financed with equity, the issuance of new stocks results in pro forma outstanding shares increasing, right? So if Company A is buying Company B and they're using stock to finance the deal, then their fully diluted shares outstanding increases, okay? So the issuance of new stock results in pro forma outstanding shares increasing. As the portion of consideration increases, the pro forma EPS decreases. So as the more stock you issue, the more the pro forma EPS decreases, right? And in a scenario where really you are financing the deal entirely with stock, then that can really have dilutive effects on the pro forma EPS. So if the deal is financed 100% with cash, no new shares need to be issued. We're still working off the same example. So it's the same Company A acquiring Company B. Now, if equity is part of the consideration, using the exchange rate ratio helps us determine the number of new shares. So let's walk through this. So if the Company A were to acquire Company B using only 100% cash, and really the acquisition share price is $1 a share, right? So if they're using $1 a share and the share price of that is $1, all they have to do is really they pay the full dollar using cash. And so now they still have fully diluted shares of 1 and they have projected net income of 15. So their new EPS is 15 divided by 1, which is EPS of 15. Now in a scenario where 50% of cash is used and the other 50% is equity, well, think of it from the exchange ratio perspective. So going back to this formula, we have the offer price and the acquired share price. So the offer price is 50% financed through equity. So 1 times 50% or 50 cents of the deal is financed through equity. So we have the share price financed by stock. So that's 50 cents. So the exchange ratio is 0.5 because 50 cents, right? So we have 50 cents divided by the acquired share price, which is $1. So the exchange ratio would be 0.5, right? And so the number of new shares issued is 0.5. So the new pro forma shares outstanding would be 1.5. We have the existing fully diluted share of 1, and then we have the new 0.5 share, so the half a share issued to finance the deal. So now the pro forma shares would be 1.5. And so EPS in this scenario is 15, projected net income of 15, divided by 1.5, which is EPS of 10. Now, in a scenario where 100% of the deal is financed through equity, well, we just issue 1 new share to pay off that 1 existing share, right? So in that scenario, we have only two new shares for pro forma shares outstanding. So 15 projected net income pro forma divided by 2 is 7.5. So the more you increase equity in the consideration of the deal, the more EPS decreases. So from 15 to 10 and then to 7.5. That's it. This is essentially like if you get this slide, then you're pretty much good to go with all the questions. So let's focus on question 1, the easiest. In an all-stock transaction, if Company A's price earnings is 17 and Company B's price earnings is 6.5, would the transaction be accretive or dilutive if Company A is the acquirer? And we already talked about this, the rule of thumb. In an all-stock transaction, if Company A's price earnings is 17, right, it would be accretive because the buyer is paying less for each dollar of income compared to its own. It's paying $6.5 relative to its 17, right? This was a common way conglomerates expanded their business holdings in the 1960s. You had conglomerates who were just conducting transactions because they realized that the target firm had a lower price earnings, and so that would really help push their price earnings up, which again eventually resulted in them being really split up because there was a lot of inefficient M&A during that era. Now, question 2. If Company A, which trades at $10 a share, wants to acquire Company B for $5 a share, would the deal be accretive when A, consideration was 100% stock, and B, would the deal be accretive when consideration was 50% stock and 50% debt? So here we have the information. So if Company A, its projected net income is 1,000, and company B, projected net income is 200. So using the approach that we had, I talked about, you first find pro forma shares outstanding and then pro forma net income. Now in this case, it's relatively easy because there's no additional synergies and all that kind of stuff. So really pro forma net income would be 1200, right? But let's look at this. So the transaction number A, the consideration is 100% stock. So the acquisition share price is 5. It's fully financed with stock, and the acquired share price is 10. So using the exchange ratio, we divide 5 by 10. So the exchange ratio would be 0.5, right? And then we can multiply that by the number of fully diluted shares, right? So we multiply 0.5 by the number of shares the target company has, right? Because that's the amount that the shareholders will receive, right? So if we multiply 0.5 by 100, we get 50 shares, and so that will be added to the fully diluted shares of the new company, so it's 150, and so then that we can divide that to get the pro forma EPS, and so that's essentially what I did. So the deal is valued at 500. We first need to calculate how much stock would be issued for each scenario using the exchange ratio. A 100% stock deal would mean, right? So we have 5 divided by 10, 0.5 times 100 gives us 50 new shares. Now the deal. So in the scenario where there's 50% stock and 50% debt, right? So $2.50 of this acquisition price would be financed with stock, right? So we do $2.50 divided by 10, which is 0.25. We multiply that by 100, and that gives us 25 new shares. So in a scenario where there's only 50% stock in the consideration, then there's the new fully diluted shares outstanding would be 125 relative to when it's 100%, it'd be 150. So we next calculate pro forma net income and then divide the new number by the new number of shares, right? So we have pro forma net income of 1,200, right? So in both instances, but in one instance, the total new shares with 100% stock. So we divide 1,200 by 150 to get pro forma EPS of 800. Now, in the other scenario, we have 1,200 divided by 125. So there's less total shares outstanding. So the new EPS would be 9.6. Right, and this, it makes sense. The more stock you use in the consideration, the lower EPS is. So the EPS is much higher when there's only 50% stock relative to the 100% stock deal. That's essentially it. Now, question number 3. Consider a transaction where Company A is buying Company B, funded 50% with stock and 50% with new debt, and is expected to generate $10 in synergies annually. The offer price is $10 a share, while Company A's share price is $50. If Company B has 10 shares outstanding while Company A has 100, using the information below, is the deal accretive or dilutive? Oh my God, don't worry, it's not daunting. Like, this is probably like the most difficult question you'll face in an interview scenario. So really, once again, approach it by starting out with that exchange ratio, right? So what is the deal valued at? What is the offer price? What is the number? What is the percentage, right? So if the offer price is $10 a share, while Company A's share price is $50, and it is funded 50% with stock and 50% with new debt, then again, we're going straight to calculating new shares issued, right? So 50% of $10 a share would be $5. So it would be 5 divided by 50, right, for a number of shares. And so we have that right over here. So the deal is valued at 100. 10 times 10. This means that 50% or $50 will be financed through Company A's shares, right? So 0.1 shares is issued for every shareholder in the target company. So based on the 0.1 exchange ratio, the company A will exchange 0.1 shares for each share of Company B, plus the $5 cash component, right? So one new share will be issued, right? Because Company A has 100 shares, right? So Company A, so times 100. So there you go. So now let's project, sorry. I was thinking, what the hell? So Company B, sorry. So you're multiplying 0.1 times 10. 0.1 times 10, that's a number of shares, right? So the exchange ratio, you find that exchange ratio and then you multiply by the number of shares in the target company, not the acquiring company. Yes. So now let's project pro forma net income. So we have a projected net income for the company, 1,000 plus 500 plus synergies of where are my synergies? Plus synergies of 10, right? So it would be 1,500 plus 100 right over here, and it would be 1,600. Now, the $5 cash component is funded through debt. When focusing on net income in year 1, the interest expense line item increases to account for this. So not only are we accounting for just the issuance of stock, but in this question, we're also focusing on the interest component, right? So the $50 in new debt, we multiply it by the cost of debt, which in this scenario is simple, it's 10%. So we have a new incremental increase of 5%, a $5 interest rate. So really, when we add the new interest expense, so the company's existing interest expense, or company on a standalone basis, was $50. We then add the transaction-related new incremental interest expense of $5. So the new interest expense in year one will be $55. Right? So go back to that illustration that we looked at. Actually, I'm going to go back right here. I'm sorry. I hate doing this, but I have to. So we have, remember, the acquirers, the standalone, so it was 1,000 plus 500, plus we had the expected synergies of 100. And then we didn't focus on depreciation in question 3, but we had the standalone interest expense, which was $50. And then we have that additional interest expense of $5 because we raised debt in order to pay cash for 50% of the deal, right? And so eventually, once we have that calculation, you can then calculate the income taxes paid, the new income taxes paid, and then get your pro forma net income. I'm sorry for jumping between. Yes, so now we have our pro forma EBIT of $1,600. We have the new interest expense of $55, right? So our earnings before tax is $1,545, right? So 16 minus 55. And then you multiply that by the tax rate, which is 50% in this example, easy peasy. So our pro forma net income would be $772.50, right? And so we can now just look at that, right? And then we can divide that by the number of new shares, right? So the standalone EPS, calculating the standalone net income over here. So we have just by itself, company A's projected pro forma net income would be 1,000 minus its existing interest expense of 50 times 50%, right? Its marginal tax rate for 475. So on a standalone basis, its net income would be 475. On a pro forma basis, completing the transaction, it would be 772.50 cents, right? So I forgot to account for that calculation. Now, so you compare the standalone versus the combined entity EPS. For the standalone, you divide just the standalone net income of 475 by its 100 shares, right? So it'd be 4.75. And the combined entity, the new net income would be $772.50. And you divide by that one new share that is issued to pay for the 10 shares for shareholders, right? So $772.50 divided by 101, and that gives you a combined EPS of 7.65. So in this example, the transaction would be accretive. Now just a quick overview. For any problem, approach a accretion dilution question by first calculating the combined company share count. You then calculate the pro forma net income of the combined entity, and then you divide the pro forma net income by the combined new outstanding shares outstanding to get pro forma EPS, and then see whether it's higher than the standalone basis and therefore accretive, or if it's lower and therefore dilutive the overall transaction. Other than that, that's pretty much it. I was kind of rushing through this video. I didn't want to make it too long. Oh my god, it's already 23 minutes long. That's long. Okay, I thought it was going to be short, but it's not going to be short. So if you found it helpful, please do like and subscribe to the channel for more. If you have any questions, please do comment below, and I'll be sure to get back to you as soon as possible. This is something really important for anyone heading into investment banking and going through the interview process. So I recommend that you do practice this and kind of check out other internet resources as well. Other than that, guys, have a great day. Thank you.